The May jobs report surprised many with its strength, as the U.S. economy added 272,000 jobs, far exceeding the consensus expectation of 190,000. Despite this positive development, the unemployment rate did inch up to 4%. This raises the question of whether this robust jobs report dampens hopes of a rate cut from the Federal Reserve over the summer. The headline figures from the May jobs report were impressive. Job creation significantly outpaced expectations, and wage growth was robust. However, the increase in the unemployment rate to 4% adds complexity to the picture. Upon closer examination, several factors help explain these mixed signals and their potential impact on Federal Reserve policy. One notable aspect of the market's reaction to the jobs report was the significant rise in the 10-year Treasury yield by 12 basis points, a considerable jump that typically exerts downward pressure on stock prices, which had pointed to potential economic weakness. For instance, the Atlanta Fed's GDP Now model had shown projections below 2% for the second quarter, a stark contrast to earlier expectations of over 4%. The strong jobs report, alongside an encouraging ISM report, brought relief and adjusted the GDP Now forecast back above 3%. The mixed nature of the May employment report complicates predictions about the Federal Reserve's next moves. The wage growth data, which exceeded expectations, is particularly important. While higher wages can fuel inflation, the reported 4% to 4.1% wage growth is not inherently inflationary if productivity gains offset it. Many economists expect favorable inflation news in the latter half of the year, easing concerns about wage-driven inflation pressures. A significant factor in the productivity conversation is the potential impact of artificial intelligence (AI). AI's implementation could significantly enhance productivity and economic growth. Forecasts from institutions like Goldman Sachs suggest AI could boost real GDP growth by 75 to 150 basis points over the next decade, a substantial impact. Currently, only about 8% to 9% of firms have fully implemented AI, but this is expected to increase. The forward-looking nature of stock markets means they are likely factoring in these future productivity gains. Even if the tangible benefits are still emerging, the stock market has shown resilience. The relationship between yields and stock prices is complex. Yields declining due to economic weakness are not favorable for stocks, while decreases driven by slowing inflation are positive. As the Federal Reserve prepares for its next meeting, market participants are keenly observing inflation trends. Inflation dynamics are also influenced by housing prices. The housing statistics used by the Federal Reserve and government agencies tend to lag behind current market conditions. Recently, both housing and rental prices have stabilized or slowed. This expected stabilization could bring inflation closer to the Federal Reserve's target.